Hey guys, welcome back to the course series. In today's video, we're going to be talking about entry types. And the first one of this three-part series is the risk entry. This is the most basic entry style of this strategy. So it's the first one we're going to go over. So I've drawn a little diagram here and also had some notes beside it. So let's briefly go over that. I'm not going to make this video too long. I want it to be more bite-sized, digestible content. It's a very simple strategy, so we're going to make it sort of brief, or as brief as possible. So to explain the diagram here, basically the criteria for entry is the same with any of the entry types within this strategy, the risk entry, the confirmation entry. The only thing where it's different is supply and demand flip zones, which we've already went over in previous videos, right? But for the risk entry and the confirmation entry, the criteria is the same, right? This is what's taught in the ebook as well. We have a solidified low point in a short scenario, right? In a selling scenario, we have a solidified low, a solidified high. We have a clear break of structure, creating an imbalance very impulsively, breaking structure, right? And then we have a retracement back to the point of origin, or the POI, point of interest, OB, order block. There's a lot of different names you can call it, refined supply and demand, whatever you want to call it, right? We have a retracement back to our POI to mitigate orders, and price drops off from there. That's where our entry is, okay? So with the risk entry and the confirmation entry, both have the exact same entry criteria. It's just how we enter the trade is very different. So with the risk entry, after the break of structure, we locate our order block or POI. Very simple. It's usually at the top, the point of origin that caused the break of structure. And we simply set and forget an order, right? We set a limit order at either the open of the POI or the 50% of the POI or order block, and the stop loss rests just above. And then of course we target either the next order block or, equal lows, equal highs, whatever the case may be, imbalance, supply and demand areas, whatever the target may be. That's not the point of this. But basically that's the risk entry. You set a limit order and just wait and see what happens, right? So of course it has a much lower strike rate than the confirmation entry, for example, which we'll go over in the next video. But this still has its benefits, and it's, there's a time and place for everything, right? So I still utilize risk entries from time to time. It just depends on my day. And so, before I dive too much into that, let's go over the benefits of risk entries that I have listed here. So risk entries are useful if you don't have time to sit at the charts for lower time frame confirmation entries, right? Because as you know, the confirmation entries that we utilize are typically based on the 1 minute or 5 minute. I know some people like to go even lower than that on the seconds charts. Not me personally, but yeah, so it's useful if you don't have the time to sit on the charts for lower time frame confirmation entries, right? You can stick to higher time frames like the 1 hour, for example, and set a limit order at a point of interest, and then forget about it, right? As long as the entry criteria is there and you've checked all the boxes, then it's still a high probability trade. There's just not as much confirmation as, of course, the confirmation entry. So risk entries are useful if you work a job and you won't be available to place instant execution orders, right? Oftentimes, when I'm sitting at my charts in the morning, I don't even place limit orders. Sometimes I just wait for price to reach my point of interest, create the confirmation entry, and then I'll actually enter the order manually, so instant execution. But I know that not everybody is able to do that. In fact, most people don't have the time to do that, right? So risk entries are very good for that. Now, another one is if you're not comfortable yet with lower time frames and you prefer to stick to higher time frames. So it took me a long time to actually get comfortable with like the 1 minute and 5 minute entries. I never used to be like that. I actually used to be more of like a swing trader, utilizing like 4 hour time frames and up, right? I used to spend a lot less time on the charts, but my style has developed more towards intraday trading, and I've really grown to love it. But like I said, it takes some time to get comfortable with the all the noise that's on the 1 minute time frame. For example, there's a lot more candles to look at. There's a lot of things that you think might be valid, but they actually aren't because it's on such a low time frame, right? There's a lot of noise. So it takes some time to get comfortable with that, and risk entries are very beneficial if you're not comfortable with it yet and you just want to stick to the higher time frames. For example, you could utilize the daily, the 4-hour, and the 1-hour, maybe even the 15-minute if you're comfortable with it. But most risk entries can be taken on the 1-hour time frame, which we're going to go over an example on Euro USD on the 1-hour time frame shortly. But yeah, you can stick to higher time frames. You don't have to go down to the 5-minute or 1 minute to locate confirmation entries. So if that's what makes you more comfortable, then this might be the entry style that best suits you. So let's go over how to best utilize risk entries, okay? And after this, we're gonna go over an actual chart example. So number one, ensure that price is approaching the POI correctively rather than impulsively. This is number one because this is literally the most important factor to having high probability risk entries. If you want to increase your win rate with risk entries, it's very important that you ensure that price is approaching the POI correctively rather than impulsively. So what does that mean? That means in a short scenario, if we were just pushing up with massive momentum, full body, huge candles, that would not be safe. That's kind of like moving in front of a, stepping in front of a moving train, right? Like you don't want to do that. There's just so much momentum. There'd be so much buying momentum sorry, getting a bunch of messages there. There'd be so much buying momentum that you wouldn't want to step in front of that, right? So it's really important that price is approaching the POI very correctively, very small body candles, very low momentum, right? Very indecisional candles, because then when it mitigates this POI, it's very likely that it's just going to drop off from that point and head towards your take profit. So that's a very, very important thing to remember. Ensure that price is approaching the POI correctively rather than impulsively, okay? If it's approaching impulsively, that's when it's best to utilize a confirmation entry, which we'll go over in the next video. You go on the 1 minute and 5 minute to see if that order block is actually going to be respected or if price is just going to push right through it and invalidate it. Okay, so number two, use less risk. Very simple. If you're concerned about your trades getting stopped out because there's no confirmation yet, simply, for example, if you typically risk 1% of capital, just simply drop that down to 0.5%, right? 0.5%. It's no big deal, because then if you take more losses, it's not as bad, right? If you have a losing streak of 1%, that can add up. If you're only utilizing 0.5% of your capital, a losing streak is just much less impactful on your overall capital, right? So these are just little things that can improve the risk entries. So number three, one of my favorites, set the entry for 50% of the order block / POI to achieve better risk to reward ratio. So basically, instead of setting your entry for the open of the POI, right? In this scenario, that bottom of the rectangle tool would be the open of the order block / POI, and the entry is set for there, right? So instead of doing that, you could simply drag the Fibonacci tool across the POI. It's going to be hard to see there, so I'm actually just going to do it away from it. You drag your Fibonacci tool across the whole order block / POI, and then you simply set your entry parameter for the 50%, the equilibrium, right? And then stop loss just above. Let's just arbitrarily put the target somewhere, 5%, let's say. Right, so let's say you've got a potential 5R trade here, right? If you were to target the open of the order block, that risk to reward ratio drops to less than 2.5%, right? So it's very drastic. It's a very drastic difference when you just target 50%. Your risk to reward ratio increases insanely. Like that's more than double, right? So it's a big deal. I basically only target the 50% unless it's like such a refined like 1 minute order block that the stop loss amount of pips would be like just like 1.5 to 2 pips. Then I would target the open of the candle, right? But if we're talking about an actual like higher time frame point of interest that you're targeting for risk entries, go for the 50%. It gives you a way better risk to reward ratio. You have much better odds like that. And number 4 on the list, the last thing I have listed here, manage the trade aggressively, okay? This means a few different things. One of the examples I put here, move your stop loss to break even, like as soon as possible. So let's say you achieve a 1-to-1 risk to reward ratio, right? Which means you've basically covered your initial risk. Maybe at that point, you could move your stop loss to break even, so it's a risk-free trade, right? Be aggressive with it. Or maybe once you reach 2R, right? You've achieved 2 times your risk, then move your stop loss to break even, and then secure partial profits, okay? Because if you do that, let's say once you achieve 2R, you remove 50% of your position, well then you've actually already banked what you initially risked for the position, right? So you've profited that much, guaranteed, and then moved stop loss to break even. So now, if price decides to reverse on you and trigger your stop loss at break even, you not only didn't lose your capital, but you actually walked away with, let's say, if you're risking 1% on a 100K account, you've already banked $1,000, which was your initial risk, and then it just takes you out for no loss, right? So it ends up being a win, a very small win, but better than a loss, right? So that's very important. Secure partial profits, put your stop loss to break even, and then as the trade progresses, you can trail your stop loss, right? So as price makes new structural highs and lows, you can move your stop loss above each structure point, okay? Because if our order block concept remains valid, then price shouldn't be breaking above these levels, right? It shouldn't be going above those levels, so it's a safe place to put your stop loss. Because if we're gonna continue order flow, it should mitigate a POI here, drop off, come back up, mitigate a POI here, drop off, come back up, etc., etc., etc. So you can continuously move your stop loss just above these areas, right? So that's trailing your stop loss. And then eventually, when order flow changes, you get triggered out, your stop loss gets hit, but you walk away with significant profit, okay? So these are all things that can make the risk entry much more favorable for you if you truly can't utilize the confirmation entries, right? Like I know a lot of people can't, so you got to go over this, right? It makes a lot of sense for people who can't be at the charts all day or who have very little time to spend on the charts in life in general. The risk entry can be very well utilized. I've used it in the past very well. So I continue to, just depends on my day. Like if I have a lot of meetings and stuff, I will certainly utilize a risk entry. So now that we've gone over that, I don't want to drag it on too long. So let's head down here. This is Euro USD, and we're currently on the 1 hour time frame. Okay, so we're going to look at a real chart example here. So as you can see, clear bearish order flow, right? We have continuous breaks of structure to the downside, lots of imbalance being created in these very impulsive bearish moves. Okay, clear bearish order flow. So in most recent price action, we have another clear break of structure, right? Price created a double bottom here, which adds, resting liquidity here. These are equal lows. We trade back up a little higher and then impulsively break through it. So of course I label that as a break of structure. Now where is the order block here? Well, it's the point of origin for the break of structure, right? So what happened right before this huge bearish move? We can identify that this little indecisional pin bar candle was the point of origin for that break of structure, okay? So if we're just utilizing the risk entry here, it's very simple. We can set the short position parameters at either the open of the order block, which is right at the bottom there, or sorry, not the open, but the low of the order block, right? So we set our entry at the low. Again, you can set it at the 50% as well. For this example, I'm just going to go ahead and set it right here. It's a very small candle anyways. Stop loss just above. You know what? Let's just make it 10 pips just to be nice and even. And if we zoom out a little bit, I've already marked a line down here because we have a daily low, okay? So in this scenario, I'm not targeting the nearest order block or nearest zone of imbalance or anything like that. I'm simply targeting equal lows because I believe that price has enough bearish momentum and healthy order flow to reach that level, okay? So here's the daily low here. We have a 10 pip stop loss. Let's drag our profit zone all the way down to that daily low, which leaves us at 9.43R, okay? That's pretty significant. Very healthy. Now you could shrink the stop loss even more. 8.5, even 8 pips. If our analysis is valid, then price should not trade above this level. If it does, then we're entering bullish order flow, right? So we don't want to see that. So technically we could place our stop loss just above at 8 pips, but I'm going to go ahead and keep it at 10. It's just an example, it doesn't really matter. So let's see if this trade gets triggered and how it performs. Okay, we're retracing. And there we go. Okay, that happened really quickly. It was just a wick entry. So price tapped in, and it actually did tap into the 50%. So we certainly could have targeted the 50% and increased our risk to reward ratio drastically. But again, this is just an example. I just decided to go for the open. Doesn't really matter. Still wonderful risk to reward ratio overall. Now let's play it out, see how it goes. Consolidating, but we're still triggered in. There we go. So as soon as that happens, we have another clear break of structure. Right? Clear break of structure, solidified low, lower high, clear break of structure, creating a new lower low. Let's continue to play price forward. Happens again, new break of structure, huge momentum to the downside, and of course it hits the take profit eventually. So as you can see, the analysis and the entry parameters, everything was executed on the 1 hour time frame. Didn't have to drop down to the 5 minute or the 1 minute. Of course, I had a level down here to target, which was from the daily time frame, of course. So that is top-down analysis, daily to 4 hour to 1 hour. But the point of the risk entry is that you don't have to go to the very low time frames. You can stick to the higher time frames and maybe use the 1 hour or 15 minute as your entry time frame rather than the 5 minute or 1 minute. Okay, so the only thing we didn't utilize here was setting the entry for 50% of the order block, which we could have, but just for the example, I didn't. Now, we could have managed the trade aggressively too. Again, this is just an example, so I didn't really go through management techniques. But for example, as soon as price broke structure here, you could have moved your stop loss, not even just at break even, but you could have moved your stop loss above the recent high, okay, right here, to lock in profits, right? So then if price decides to reverse from here for some reason, you'd be tapped out of the trade, but you'd be left with profit and, especially more importantly, not a loss, right? You'd be left with profit. So that's a big deal. And then, in this specific scenario, price took off really quickly to the downsides. There wasn't much structure created to manage the trade further, but you certainly could have protected yourself by putting your stop loss here, which means it's impossible to take a loss at that point. Okay, so this was just a brief rundown of the risk entry. I don't want to elaborate too much on it because it's actually pretty straightforward. You literally set an order, set your stop loss just above the order block. We all know what order blocks are. We've gone over them. It's in the ebook as well if you ever need that for reference. It's very simple. Now, again, this entry type has a much lower win rate than the confirmation entry, for example, but it also depends on the trader because some traders get confused by the lower time frames, which means they could have a lower win rate using the confirmation entry. If the 1 minute time frame confuses the hell out of you, then the confirmation entry might not work out for you very well, right? If you're comfortable with the low time frames, the 1 minute, 5 minute, then you can really utilize confirmation entries to get a very high win rate. But if you're not comfortable, then risk entries are the way to go. And as long as you utilize these tips here, you can really have a highly probable strategy, right? And again, the entry criteria is the same. It's just simply how we structure the trade that is different, okay? So that was the risk entry. Stay tuned for the next video on confirmation entries.